Good afternoon, Darren Amos again. I'm going to talk to you today about the new tax rules relating to your buy-to-let property. Some of these you should be aware of, some you may not be, but everything changed as of April the 6th this year. So all new rules apply, all the old rules don't apply anymore. So first of all, do you understand them? And that's really important if you're renting out property, whether you're a single landlord, a multi-property landlord, it all affects you. So let's have a look what's changed. So from the 6th of April, so effectively now, because we're already past that, there have been 4 major changes. The first one relates to taxation of rental income. This has been phased in over the last 3 years, so you should be aware of that one. It's fully implemented now. Capital gains tax calculations for properties you have previously lived in has now changed. Perhaps a lot of people will be aware of that. There are a lot of people out there with what we call consumer buy-to-let or let-to-buy properties. Lettings relief on property you have lived in. So this is a property where you partly rented out, part of it, that sort of thing. Again, and then not so common. Most people weren't even aware of the lettings relief existing, but it has changed. And the final one is a major change to the payment of capital gains tax itself. So I shall move on to the first one. Rental income mainly affects high rate taxpayers. Now this is fully implemented, just confirm that. So assuming your current income from other sources is over £50,000, you're a high rate taxpayer. Under the old system, the rental income of £25,000 in this case, you have mortgage interest of £10,000, made a profit of £15,000. That £15,000 was then taxed based on your income being above the threshold, so you pay 40% tax on that. So the total tax due would have been £6,000 on that. Under the new rules, you're taxed on the 25,000 rental, not the net profit, the rental. The mortgage interest is the same in this case. The profit's still 15,000, but actually you've been taxed what, £25,000, not on £15,000. So the tax on this would be £10,000 as opposed to £6,000. You then have rental relief, which doesn't apply under the old rules, under the new rules, and that's based at 20% of the interest. So in this case, 20% of 10,000 gives you 2,000 back. So your initial 40% tax on 25,000 is £10,000. You've got 2,000 relief, so you end up paying £8,000 in tax, compared to £6,000 under the old rules before they started phasing them in. So significant difference. But it doesn't just affect high rate taxpayers, because they're adding the income from the rental in total onto your income. This pushes many people into the high rate tax band. So some of their income is in high rate, some isn't. So here, I'm going to go over a quick example for that for you. So in this case, we're under 50,000. I'm going to assume 35,000 just so the numbers work. Obviously, you need to put your own numbers. Under the old system, your current income was ignored for this purpose. Rental income of £25,000 was the only income. Mortgage interest take off £10,000. So profit was £15,000. And you see, I've changed that slightly. This was assessed at £15,000, is comfortably with £35,000, still leaves you as a basic rate taxpayer. So you've got tax due of 20%, £3,000. No rental relief, because that's the old rules. Current rules, current income 35,000, rental income 25,000. That gives you a total income of £60,000, which is £10,000 over the threshold for high rate tax. Mortgage interest and profit hasn't changed, but in this case, £10,000 of your rental income, because that's the 10,000 over the tax threshold, is charged at 40%, and £15,000 of it is charged at 20%. So you pay £7,000 tax on that. And then we offset the 2,000, which is 20% of the mortgage interest, giving you a net cost of £5,000 in this case. So you can see it's a couple of £1,000 more than the old system. So everybody's going to be worse off. In many cases, I'm using quite big profit margins there. You'll find a lot of people with higher mortgages, with high LTVs, are paying higher interest rates. Perhaps the profit margin there isn't there. So the actual tax that's now due at under these new calculations could make it not particularly profitable to have a buy-to-let. And that's what people have been talking about for the last 3 years, has been phased in. Now, if you're a new landlord, you won't know about this, so it's just a case of knowing how the numbers work. Okay, so let's just recap on what we should have already known. The next change is a new one. Previously, when you had a capital gains tax on a property you've lived in, previously if you offset the number of years you lived in the house, and you could also offset the last 18 months of the rental period as well. And this was taken away from the total gain to give you a smaller taxable gain. What's changed is that last 18 months bit is now 9 months only. Doesn't sound like a significant difference, but that's nearly a year you've lost of your offsetting. So you're going to be paying more tax on capital gains tax. The calculation is fairly straightforward. Now, I'll give you a scenario here. You have owned the house for 20 years, bought it for 100,000, sold for 200, making a gain of 100,000. Obviously, I'm keeping the numbers simple. You lived there for 11 years yourself, and then rented out for 9 years. So you already lived there for 55% of the time you owned it. Adding the 9 months onto this, which is obviously 0.75 years, means you effectively lived there for 58.75 of the time owned. You then can offset 58% of the gain, meaning you're assessed on 41.25%. Under the old system, you'd have got a 37.5% assessment only because you'd have been allowed another 9 months. So it does make a difference, you can see, and obviously in this case that would be more money in tax. And obviously the less the number of years are, the bigger impact that makes as well, of course, because 9 months is it's not a very big percentage of 20 years, but it could be if it was only 10 years you'd own the property. So that's quite a big change. A lot of people haven't realised that one slipped through. The next one is lettings relief. Not as common, but this has changed completely. You can now only claim if you actually reside in the property as well as the tenants. Not a very common scenario, so not many people claim upon this. Under the old rules, you didn't have to be actually living there at the time of the claim, but now you do. It's not rent a room, that's a different system, and that should be discussed separately. This is actually, and they give you up to 40,000 in relief against your capital gain. Another example here, same property bought for 100,000, rent out a large bedroom with a company living area, broadly speaking, 20% of your property. You then sell the property for £200,000, making 100,000 gain. Now, as we all know, private property residence relief, normally when you sell your own house, means the capital gain is wiped out automatically. In this case, because 20% of your house is effectively a buy-to-let, then you've only the private resident relief only applies to 80%. It means that you've got £20,000, 20% of the £100,000 gain you've made, subjected to capital gains tax assessment. Now, obviously, sometimes this would be below your tax threshold anyway, so it will be taxable. But in this case, lettings relief would apply up to £40,000. It's capped at whatever your gain is. So in this case, 20,000. So you get a full £20,000 relief, and there would be no capital gains tax due. But just something to be aware of, that the big change there is at the top there. You must actually reside in the property with the tenant. And that's not very common. So I don't think it'll affect too many people. Now, the final one, capital gains tax payments. This is probably the most significant and important change, and seems to have slipped past most people's knowledge. It's the most important one, in as much as it's going to be quite a big impact on you financially. Previously, when you sold a property, you entered the gain made onto your next self-assessment tax return. Any gain would then be combined with other taxable gains and losses for taxation purposes. The calculation would be done by HMRC, and typically you would end up paying the actual tax due on the sale a year or two after the sale, depending on when you submitted your tax return. So you had plenty of time to adjust to the fact you had to pay some tax, perhaps make some use of the capital in the first place, invest it in new property, etc., what it might do. But now, this is the real big change. You must complete a capital gains tax return and pay the tax within 30 days of the sale. That's 30 days after the completion of the sale. Your solicitor's date will be, say, the 1st of May. The house sale's finally gone through, funds hit your bank. You now have to go to HMRC's website, fill in an assessment form, and be taxed immediately. The big thing with that, of course, is you can't offset any gains and losses for the year because you don't know what they are yet. You haven't been assessed yet. So you'll be paying the full amount. I'm not sure at this stage whether, having not done this for myself, whether you actually can use your annual allowance against this. I doubt so, because again, depends on whether you have other capital gains and losses in the year. So what would actually happen almost certainly is your self-assessment at the end of the year, you would then claim back any overpaid taxation. And just to remind you that in most cases on residential sales, capital gains tax is paid at 28% if the gain added to your income exceeds a high rate tax threshold. So and typically most people make enough profit on their sale to put them straight into the high rates tax band without their income. So that's usually the case. If you're fortunate enough not to have made a big gain on a property, perhaps that's in an area that's not growing so quickly, and you have a relatively low overall income, then you could still be a basic rate taxpayer, including the income from the capital sale. If that's the case, then you would pay 18%. And obviously, if there's a crossover between the two, you might have a bit of tax in different areas, right? And obviously, you can offset other losses and gains against that, but other capital gains are charged at different rates. So always try and offset your allowances against the residential sale if you can, because that's a better saving for you. Hopefully that makes a lot of sense. I hope that you understand that and that you're aware of it, and if not, that you can use this as a reference point. And obviously at the end of the day, bottom line is, if you're in this market, you should really be using a decent tax advisor. Speak to your accountant, make sure that you get everything right. Your solicitor, when you make a sale, will obviously be involved in that too. And just making sure that everybody understands the variation. So that's me for today. Hope that's useful, and look forward to another one. Cheers.